Okay, so we are back with one another video, and this will be covering really important points for the CFA L3 exam. It's going to be very beneficial for me, and I hope it's going to be beneficial for you too. So today we are going to cover the CME, which is the economics or the capital market expectations, and we are going to cover reading 10 onwards. So quickly starting, reading 10 is all about what is expectation from the capital markets. So in short, what they are telling you is that whenever you are taking a portfolio approach for your investments, you can actually have a set of expectations for the perceived risk and the return that you want from your portfolio, and what are the macroeconomics and the microeconomics factors which are impacting the potential returns and risk of the portfolio. So the role of a CME is to basically use to forecast the expected risk and return. That's very obvious. And there are two important terms written over there in the Schweitzer book. There's the cross-sectional consistency and the intertemporal consistency, which means that in case when you're having a portfolio approach towards your investments, you should have a cross-sectional consistency. That means your risk and reward or your risk and return expectations should be consistent across all asset classes. And intertemporal consistency is basically across all time horizons, like whatever is your perceived investment returns and perceived investment risk, it should be consistent across all time zones. Basically it means in the short term and the long term you should have consistency in your investment approach. So that is one of the thing that is expected on constructing a proper asset allocation based portfolio. Then there is a small framework which helps us to build the CME approach. That is define the CME as per the asset class and horizon constraints. Okay, so now the CME could be short term or long term. I could have a short term expectation of the inflationary pressures, or I could have a long term view of the growth in GDP. Now there are two types of investors. One could be short term investor, one could be long term investor. So based on the investor type and the asset class they wanted to invest, you should define the capital market expectations. Here you can have short term expectations for inflation, and you can have long term expectations for GDP growth, because in long term the inflation is not a concern, but inflation is always concern in the short term. So based on the horizon you generate your CME expectations. Then investigate factors for which historical performance and for which historical performance was historical performance was result of those factors, and project the future performance. Now it's very complicated in the book, but it means a very simple thing, that those factors which impacted the historical outperformance or underperformance of the portfolio, just take it as it is and project if it repeats in future then what will happen, or you change those variables and see project what will happen. So like an example, in if in 2008 the crisis happened and the interest rate went low, and after that there was a lull period of 2 3 years, and then the equity market started firing. So you can take that kind of scenarios, like in the historical decade in 2000 to 2010 the equity performed this in this returns, and these were the reasons because of the underperformance, and these were the reasons for the demand to come back. So in case those factors were responsible for the outperformance or the underperformance, like GDP growth, or you could say unemployment, or you could say inflationary pressures, or you could say the USD strengthening or USD weakening, or you can say negative yield. So those factors which are impacting the historical performance, take those into consideration and project your future performance. Then third is the identify the valuation model. So basically, which model you are using for your portfolio. So you can have a relative model, you can have an absolute model. A relative value will have basically comparing two stocks of the or two portfolios of the same nature and same asset allocation, and then comparing the relative value, or comparing asset classes based on those relative value. Or you could have an absolute value valuation approach. That depends, and it really depends on what kind of portfolio you are making. Then collect the best and accurate data for forecasting, self-explanatory. Use experience and judgment to assign values to the factors being used for forecasting. So in the point number two, we defined that okay, these are the factors which were responsible for the historical performance. But going ahead, these factors might remain same, but their value might change, right? So based on your assumptions and based on your knowledge and based on your view of the market, you can adjust these values of these factors to see what will be the impact on your forecasted values. Then formulate your CME is basically record your assumptions. Is basically keeping a record of what assumptions you have used to formulate your CME, because in the later stage, after 6 months or 1 year, when you do a portfolio review, you will not remember what was your judgment because of which you had created the CME framework. And the last one is basically to always improve your models. So you have to do a back test and check whether your model is close to the expected value. If not, then it's time to change the model or change the factors which are impacting the model. So moving on, obviously forecasting is based on assumptions and no one can actually predict the market. So there will always be problems in forecasting, right? But what are these problems? What are the common problems? First is a limit on economic data. Yeah. See, not all nations and all countries are so transparent and so efficient to give all the economic data in time. Most of the economic data are lagging indicators, and they come up very late, because of which you tend to miss the or you tend to forecast the market in an incorrect way. The second is data measurement error and bias. Obviously, whenever there is a forecasting and data historical data is involved, the judgment can be biased at for some things it could be because of survivorship bias, or it could be look ahead bias. In case of illiquid securities, it could be the appraisal index, which is it is not updated on time, and there's a bias of the because of the price, stale price. Then limit on historical data. Third part, it is basically it depends on what kind of horizon you are looking at. So in 2021, if you are doing a analysis and you want to see a period between 2000 and 2021, you might have a period of extreme stress between 2007 and 2009. And now, because of this period being really stressful, you need to change your data, because otherwise it will be quite biased, right? It will be quite skewed, because the equity prices were depressed at that time. So based on that historical data, you might do a wrong projection of your CME or your expectation for the portfolio. The fourth is quite self-explanatory, is the use of ex-post data. It's basically ex-post is obviously historical, and it is the same problem that you're using the historical data to, basically for project or forecast the future. Fifth is non-repeating data patterns. In the book, it's written in a very complex way, but it's simply meaning that you are because of your data, you're trying to find a pattern which is actually not a pattern, and it might just be because of some spurious correlation, and because of that you're expecting that the pattern will repeat in future, but that pattern was only because of some coincidence, and that's not going to repeat in future. And based on that, if you project that it's going to repeat in future, then this will be a big problem in your forecasting, right? Then sixth is failing to account for conditioning information. It is simply that suppose you had built the model based on some correlation of your equity and GDP, or some correlation of your bond prices and inflation and what the monetary policy is doing. But now, because of some structural change in the overall economy, maybe suppose the trade policy has changed, or maybe the currency policy has changed. Now the new information has come in, but if you are using the old model with the old factors and old coefficients, your model is not taking the new information into the picture, and that is why your forecasting might be you know s- away from the actual economic condition. Misrepresentation of correlations is similar to non-repeating data patterns. Is basically you might have a certain, when you are dealing in 10, 20, 30 years, you might have patterns which look to be correlated, but in actual scenario it might just be because of some coincidence. So that kind of backtesting is important. That is why backtesting is very important, to see whether these correlations were actually true, and whether these variance covariance of the security actually held for a longer period of time. Eight are the psychological biases. We have done this in behavioral finance, so I'm not repeating this. It's part of the same behavioral finance, the biases that investors or traders or portfolio managers have. Ninth is the model uncertainty. So model uncertainty is basically your forecasting is as good as your model. Okay, so it is important to select the right model for the right asset class. Okay, basically the model should match with what the asset class attributes are, and the model is very sensitive to the input data, right? So if your model is very sensitive to certain factors and those factors itself are not computed properly, so your model becomes really unstable. It's not a reliable model. So for to basically to do a reliable modeling, what usually people do is basically they run applications or programs on Python and R, and they do big data analysis. They use machine learning or AI to see how the model is close to the actual data, and they run a reverse thing. Basically, they run in actual what is happening is firms across risk management, what they're doing is they are actually putting the reverse modeling, wherein they're putting the result and seeing what factors or what you know correlations will give us that results. So because for that you can't do it on Excel and all your normal computer programs, you need big data platforms and processing power of R or Python, so that huge data of 20-25 years can be processed. uh, Another important topic is trend rate of growth. It is basically how fast your economy is growing. The macroeconomic is growing. So there is a lot of knowledge-based things which are given, but I've just highlighted the important points. So there are some exogenous. Exogenous means external shocks which can impact your country's growth, right? Even if your country's decisions are good enough, there are some external shocks which can impact your entire macroeconomic scenario, like a geopolitical war which is going on in your neighboring country, or there's a tech progress which has happened, and because you can have a tech progress which whether you are lagging or you have already progressed in tech, but your economy is not ready to catch up to that tech. Then natural disasters, very very common in emerging countries, like natural disasters can actually force the countries and states to make immediate financial decisions in terms of reliefs and aids. Financial crisis, obviously, like in 2008, India was not involved in any of the uh, say mortgage backed security, right? India was not even exposed to those securities. But what happened, because the US failed, and it was a domino effect, and it just came to all the countries which were part of those financial network. Natural resources discovery is again a big problem. So we have discussed in our level two that natural resource discovery could actually be a problem for a country, because if the country is you know either not efficient to extract that resources, or putting all those resources into putting all their employee and labor into this thing, then it becomes a problem for the country. So natural resource discovery could be both a boon or a ban. It depends on what the country has as a capability, to whether they can extract and actually utilize those natural resources for their country. So three important points for the trend rate. That trend rate of growth acts as an anchor for long-term growth in equity and debt markets. So you see, how much ever you try to project the market in short term, the market will always go on the upper side in the long term, right? In the extremely long term, in 10-15 years, the market will always go up. It is because somehow in the longer term, your economic activity and your stock market prices will, they will coincide. So long-term rate of growth. So long-term investors like say Warren Buffett, or say for India Rakesh Jhunjhunwala, they don't take short-term decisions. They might take trading decisions, but their core portfolio looks at the long term, how much the nation can grow in the long term, and based on that they invest. Second is very common. We are facing this in India right now. Higher trend rate growth may lead to inflationary pressures. Obviously, now the economy is just opening up, and you can see the prices skyrocketing both for commodity, fuel, even the equity prices are skyrocketing. It is because of the pent up demand which has come up, and since people were locked in and they're now starting to move out, the hotel demand, the flight demands, everything is going up, which is causing some transitionary inflationary pressures. So when we say transitionary, is basically a passing by. So when these people, they go back to, they have done their holidays, they have purchased their things, they have done all those, revenge shopping, the inflationary pressures will cool down, and it will just, be a part of your normal transition. So higher trend rate growth may lead to inflationary pressures, because if your growth is more than your capability, somewhere you will face a problem, right? If I am supposed to grow my portfolio at 10% and the economy is growing at 10%, say example, and my portfolio is growing at 40%, that means at some point of time there will be a problem, right? So the growth should be in line with the actual growth of the economy. A model for forecasting growth rate, it's very simple. We have done all our life for CFA, which is the labor input, the capital plus capital per labor, which is K by L, and the TFP is basically the technological progress. So TFP is the main factor for computing the output. Okay, so there are three models which are used for market forecasting. The first one is the econometric analysis. Basically, it's a statistical way of analyzing your, or forecasting your economy. It is having some advantages and disadvantages. And advantages are very simple. It is reusable and it is quantified. So since it is a statistical tool, that means it's based on numbers, and numbers and models can be reused and they can be quantified. So that way it's an advantage. The disadvantage is very obvious since it's obviously again statistical. It is not common to for all the fund managers or all the economists to read and understand that in entirety. So it's complex and time consuming, and obviously statistical data tools will always rely on the input data. So in case the data in itself has some issues, the output will have some issues. The last point says it doesn't work well for inflection points. It's basically like we see in 2020. 2020 the market fell like anything, but it was very, it's close to impossible for any statistical tool to find that thing. So because it's a part of inflection, right from positive growth you're moving into negative growth, and you are seeing negative prices all the way, and then you again seeing the prices going up. So this kind of data modeling, for any statistical tool to do that, that much of historical data and those many scenarios needs to be put. Otherwise no model can actually predict the inflection points. The second is economic indicators. Now, these are very common indicators that you hear every day. You read about it, like what is your GDP growth, what is going to be your output, what is going to be your fiscal deficit, what is going to be your capital deficit, what is going to be your trade gap, how much is your currency going to appreciate, depreciate, what is your forex reserve. So macroeconomic indicators, leading and lagging and current. There are three types of indicators. So lagging is obviously basically based on the past data. So like every month, the government of India releases what is the manufacturing data, what how much manufacturing happened. Current may be basically there's a monetary policy committee happening today. So as of day, what is going to happen. And leading is basically wherein all these meetings and all these councils, the leaders basically announce that what is their expectation, what is their expectation for output, what is their expectation for GDP in the coming year. So those could be the leading indicators. Advantages, obviously it's simple and easy, and data is available everywhere because it's coming from the news agencies and the government itself, and it's in a very simple language for everyone to understand. And disadvantages, historically, it has been ineffective or inconsistent. Now, it depends on which country you are looking at this data. We are doing the CFA curriculum for USA. So, as per the USA economy, the economic indicators have not been that effective and that consistent in predicting the market. But in India, it might be. So, it depends on which country you are looking at. Checklist approach is a simple thing wherein a subjective questionnaire, or basically about the economy overall, and you know the factors impacting the output, the growth factors, the factors which can inhibit the growth, what is could be the inflation, and so that it's basically a checklist approach, a scoring approach, which allows us to forecast the market. So based on your market survey, they will predict what is the or what could be the market forecast. Advantages, obviously this is this least complex process. It's a simple question answer kind of a thing, wherein based on the macro or the majority people answering the common question, that becomes, when I say people, it's not retail people like you and me. It's basically analysts, financial people, people who are dealing in the country's finance, output, industry, and all those things. Disadvantage is obviously, since it's subjective and it requires a checklist approach, it's always time consuming. and it's not really reusable, right? If you see the part one, which is the econometric module, in that the advantage is it is reusable, but this checklist approach is again and again whenever you are going out and checking, going to check what is the pulse of the economy, you always have to change your model, change your questions, right? So in that sense, this is a big disadvantage. So one thing to remember in exam is, if the data is, if the output is based on a model, it is reusable and it is advantageous. But if the output is not based on a model, it's basically subjective, it's a disadvantage. Then we have one section of the business cycle. This is very simple in the real sense, if you understand that there are various stages of business cycle. So initial recovery, early expansion, late expansion, slowdown, and contraction. So let's take an example of these items. I'll just use some, maybe I'll use a blue color. Yeah. So let's take an example in 2020. Right now we are 2020 March. So in 2020, what happened? So the economy was doing good, right? But because of this COVID, suddenly everything went down, and the interest rates were forced to be decreased by the government to support the people. Because if the government did not reduce the interest payments or the interest rates, the manufacturing sector, the SME business, the retail, retail debt holders, they would have lost a lot of money, and they would have, actually gone out of the business. So whenever there is a pressure from the economy to, run the business, or there is some issue in the market or crisis in the market, the interest rates are generally low. But we saw that in the mid of 2020, the market started to come back, right? So this is your initial recovery stage, where, interest rates are low, the government is stimulative, it is actually stimulative, the government is supporting the market, and the stock market is rising. So rising stock market is basically actually an analogy which is not correct over here. It is basically the recovery of the stock market, because before the initial recovery, the market was always in a contraction or a recessionary phase. And whenever the market comes out of the recessionary phase, the first asset class to fire is the stock market, because that is the most liquid market. So we saw this in mid of 2020. The nation was in initial recovery stage. Right now we are in the early expansion stage. India is currently in the early expansion stage, actually ending in the early expansion phase, wherein the short term rates are increasing, but in India and overall the world, the short term rates have not been increased. So we are still in the recovery phase only somehow, but the rates have not been increased. Increase in confidence, yes, the manufacturing numbers, the spend by the general public, and the household numbers, the real estate numbers gives a indication of how much the people have confidence in the economy, or the investors have. And obviously this is going to be constant, the rising stock market. So we explained why the stock market is rising, right? Because there's surplus money in the market, the interest rates are low, the central banks is printing money, borrowing is very low. So the hedge fund managers, or the extremely liquid funds who are borrowing at a very short term rate. Say suppose they are borrowing at 4% on annual basis, and they're investing in stock market. So you can imagine how much money they can make. So as long as the interest rate remains low, the stock market will always rise. Late expansion. So India will sooner or later, in fact, the entire world will fall into this category sooner or later. Inflation concerns, because right now the interest rates are low, so borrowing is very easy. So everyone is borrowing, everyone is buying things on debt because the interest rates are low. But because of that, what happens? The demand goes up, and when the demand goes up, the prices go up. Yeah, because if I keep on demanding that I want cars, I want this, I want that. So the people who are manufacturing all these things like cars, no real estate and all those things, they will be forced to increase their output, right? And to increase their output, they have to buy more raw material. Now what happens? Because of the demand, the raw material starts to go up. Right now that's happening in India. The metal index is at its peak, The fuel and everything is at its peak because the demand has gone so vividly up because of the opening up, that the raw material cost or the commodity price is at its peak. So that is why you are seeing stocks like Hindalco, Tata Steel, and all those guys. They are just firing like anything. So rising interest rates, because once the inflation becomes concern, obviously the central bank will increase the interest rates, and peaking out of our equity market. Yeah, when the interest rate goes up, the equity market usually starts to correct and stabilize. Slowdown is obviously very common. That now, the because of the interest rates going up, now the borrowing has gone down, the expansion plans have gone down, the government spending has gone down. So rising short-term rates, possible inverted yield curve is basically it's an indication of recession. So let's see what does this mean. Let me just clear all this thing. So right now what you have is your rising short-term rates, right? So rising short-term rates. Now the economy is not doing well, right? So what will happen? The government will start to do the interest rate corrections. Now this is an inverted yield curve, right? Because right now you are here, and at this level, maybe your interest rates are say 4%, and over here it might be at 2%. This is an inverted yield curve, right? And in obviously in India there is no negative returns. So in USA, or not in USA but in Euro, obviously the returns go below zero. The yield is below zero also. So in inverted yield curve is basically an indication of a contraction. Increase in bankruptcies, falling interest rates. I said over here, the interest rate will start to fall. And when you see an inverted yield curve like this, the contraction period is about to start. Stock market is falling in the start, and then rising market marking the end of recession. Rising marking the end of recession means the economy will move back to the initial recovery from where we started. So that's pretty much about this entire business cycle. Important terms: inflation, disinflation, and deflation. So inflation is basically, that inflation is very, your consumer price index was 100, now it's at 107. So it's a 7% increase in your inflation. Disinflation is basically inflation is still rising, but the rate of increasing has gone down. So from 100 to 107 was 7%, and from 107 it might rise only to 109, right? It could be some 1.5%. Inflation is rising but at a lower rate. Deflation is where the inflation is going negative. Okay. Okay, the most important part: monetary and fiscal policy. So important points to remember: the neutral rate is the rate that balances the growth and inflation, right? So we discussed that if the YTM is lower, people will start buying more. They will start taking more loans, start buying home loans at a very cheaper rates. And because of that, the economy will heat up and the inflation will go high. To curb the inflation system, the central bank will increase the interest rate. But at what rate will the economy balance itself? It should not increase it so much that the economy goes into recession. So what they do is basically they try to find a neutral rate at which the growth and inflation are balanced, right? They also want the people to buy more, but they don't want everyone to buy more, right? Because if the interest rates are low, then everyone will buy more. So they find a rate at which these both the things get balanced. So what is that rate? It is the neutral rate plus the target inflation, output gap of the GDP into zero point 0.5, and expected and the current inflation into zero point 0.5. So this is a simple formula that you need to remember. And fiscal policy is basically, it depends on where at which business cycle is, and they can take an expansion or a contraction view. So important thing over here to really remember is the yield curve behavior of the yield curve in terms of the monetary policy. So this table is self-explanatory. So when the fiscal policy is expansionary and the monetary policy is expansionary, The interest rates are low. What will happen to the economy? Everyone will buy. So booming economy. Fiscal policy is restrictive and monetary policy restrictive. So what will happen? Interest rates are high because fiscal policy is monetary policy is restrictive. Fiscal policy is restrictive means government is not spending more. So what will happen? Because the interest rates are high, the SMEs will not survive. The small medium enterprises will not survive. There will be slowdown in real estate. There will be slowdown in rental and leasing income. So because of that, the economy will go down. So downward sloping yield curve, recessionary. Restrictive and expansion. So this is important. Fiscal policy restrictive, monetary policy expansion. So when you say monetary policy expansion, the interest rates are low. But when the fiscal policy is restrictive, that means the that yeah, monetary policy is expansionary, right? Monetary policy is expansionary. That means the interest rates are low, and because the fiscal policy is restrictive, the yield curve will look like a steep yield curve. But in fact, actually, it's much more steep. It will be like this. So this will be your yield curve in restrictive and expansion. So it's steep. It's unclear what will happen to the yield curve. The opposite of that is also true. Fiscal policy is expansionary, where the government is ready to spend at a lower interest rate, but monetary policy is restrictive. So in that case, you have a flat yield curve. So no direction. You don't know what is the yield curve direction. So flat and unclear. Always remember two things. In short term, the economy is impacted by monetary policy. In long term, it is impacted by the fiscal policy, right? Because monetary policy is a tool that the central government or the reserve banks use to curb the inflationary pressures. So it will always be in a short term. So I guess that's it for reading 10. I hope I have covered most of the important points. I'm not trying to replicate the book over here, just a tool to remember the important things. Thank you guys.